So let's start the second part of the revision session. Is if there is an if uh, there is any question based on whatever we have discussed so far, feel free to ask. Otherwise, we can continue. Okay, so uh, so yesterday I think we finished till the chart patterns of cup and handle, um, and there is one more concept of continuation pattern which we are left with. So basically, in the continuation pattern, it is, I mean, it could be a bullish continuation or the bearish continuation. So what it means that whatever is the main trend, okay, after a certain period of time, the stock will go into the sideways also, and then it will continue moving in a same direction. Okay, so this is example of a bullish continuation pattern where the um, before it is into a kind of a sideways move, the overall trend is bullish. Okay, so if you look at in this example, what is happening is uh okay, okay. So from the below, it is going up and up till this price point, and there for a certain period of time it is kind of a sideways trend, right? And once this sideways trend again break a breakout is happening, it is again continuing in the upward direction. So in the bullish continuation pattern, this is flag and pole is the one concept, okay, where the sideways, if you connect the all the highs and all the lows, okay, during the sideways move, so it could be maybe a form a rectangular shape or the triangle kind of shape or rhombus kind of shape. Okay, no matter, I mean, this there could be a different shapes. Okay, it could be triangular, rectangular, sometimes square, sometimes rhombus. But once it will break out the the upper part of the flag. So it is there will be a two levels. So one level could be equivalent to the height of the flag, and height of the flag we will measure where the width will be more. Okay, so that will be the first target, and the second target will be the equivalent to the height of the poles. Height of the pole will be determined from where the main trend is started till it went in a sideways. So in this flag and pole, the two targets are depend on the will based on the height of the pole from the wider side, and the second, sorry, height of the flag from the wider side, and the second target would be the length or the height of the pole. Okay, so if you look at this example, the both the target has been achieved successfully. Okay, and the second continuation pattern example of again the flag and pole in the bearish. Okay, and where the main trend is kind of a falling market or the downside. Okay, so this is again this is the ONGC example. If you look at the from the all-time high, it has started falling. Okay, and while the stock is falling down, it is taking a support at a certain point of time, and from there, it is in a some kind of a continuation pattern. And the example that we are looking into the weekly time frame. So weekly time frame means it is a very kind of a little longer term view. So either someone when they identify these kind of confirmation pattern, right, and when the sideways move is happening, so they may decide to take an entry when this continuation pattern, I mean, this is in this example there is a kind of, you can see the flag in a is a rectangular shape and a little bit tilted. Okay, and so from this price couple of weeks it is on the sideways, and once it is breakdown is happening from the support line, so one can decide to take an entry at the breakdown point, and the first target could be the height of the flag or from the wider side, and the second target would be the height of the flag, sorry, pole itself. Okay, and this in this example also both the targets has been achieved beautifully. Okay, so this was the concept in uh, a kind, I can say, the part three, and we are left with one more concept of part four, where um, we have discussed on uh, technical indicators and the divergence. And the technical indicators has two parts. One was MACD, and there was oscillators, and the second part is divergences. So again, just going to the MACD, the part one. It is full name is moving average convergence divergence. Okay. And the oscillators have the two again kind of a branches, which are stochastic and RSI. RSI is full form is relative strength index. So when we look at the MACD, so MACD basically it helps in deciding the main trend of the particular stock. And typically we observe the MACD in a little higher time frame. So for example, uh, whatever the time frame we are choosing for the trading or investing, MACD we will look at MACD in one level high. So for example, we wanted to do the some investment, for a long term investment. So typically we observe, or we'll analyze the chart in a daily time frame, or we take the trade or the investment considering the daily time frame. So to identify the main trend, we we need to move a little bit higher time frame, one level up. That means from as compared to daily, weekly will be the higher time frame, and that will give us a what is the main trend. And based on the main trend, the further analysis will happen. And once the main trend, whatever the direction is providing, if the other indicators are also in sync with that, that means whatever the analysis we are doing, it is in our favor, and we can confidently take the trade or do the investment. But if there is not in sync, so better to not take an entry. Okay. So as in this picture, the picture is depicting MACD has just two lines, and the third one is called histogram. And it's a very simple. I mean, whenever there is a positive crossover is happening, that means the blue line is crossing red line in an upward direction. It is called as a positive crossover, and it is a potential buy signal. And reverse, whenever there is a negative crossover, that means a blue line is crossing the red line in downward direction. It will be a potential sell signal. Okay. We can look at few examples. So this is example of ICICI Bank, where based on the MACD concept, there are different buy signal and sell signal. So that this is the first place where the positive crossover is happening. That means blue line is crossing over the red line in upward direction. That means the buy signal. And similarly, the blue line is crossing down to the red line. That is the called negative crossover, and it is a potential sell signal. And there are few more examples in the same chart, right? Yeah. The oscillator, as we just discussed, has a two. There are two type of the oscillators, stochastic and RSI. And why it is called as a oscillators? Because it oscillates between kind of a two lines, maybe between 0 to 100. Okay. And within the 0 to 100, I think is a most of the movement you can see it is between 20 to 80, something like 20 in a lower side and 80 at the higher side. So that is the most of the time it will be. Okay. This is another example of stochastics. So stochastic is basically again the equivalent, I mean, similar to the MACD, where we don't have a histogram line. Okay. And what it shows kind of a similar characteristics, right? So whenever there is a positive crossover, that is blue line is crossing the red line in upward direction, it will be treated, it will be named as a positive crossover, and it is a potential buy signal. And whenever the blue line is crossing down the red line, that is called as a negative crossover, and it's a potential sell signal. Okay. Just a few additional, concept within the stochastic, that, for example, if any point of time, or maybe not in particular time, for a certain comparatively longer period of time, if the stochastic remains above 80, okay, so that is, that area is called as a overbought region. I mean, in a conceptually, but in a practical way, there is nothing called overbought. I mean, wherever any trade or you know trade is happening, the number of bought shares are equivalent to the number of sold shares. But for the concept perspective, if it is remains for a longer period of time above 80, it is named as overbought region. And similarly, if it is below 20 for in a certain period of time, that particular duration will be called as a oversold region. And what is the it signify what it does signify, that the longer for a longer period it will be overbought region. It again gives the more kind of a stronger conviction that, okay, maybe any point of time as soon it is going to be maybe some correction or some fall. And similarly, if it is comparatively a longer for a longer period, it is under below 20, that means the oversold region. So again, that will be a indication that, okay, after a certain period of time, the price is again, market is again going to go up for that particular stock. Okay. Yeah. And the concept was, RSI. So RSI is, it is one of the very, very strong concept when we learn about futures and options. Okay, but for now, you can just understand that RSI is like, what I can say. Um, it's basically the momentum. It shows the momentum, right? So, um, if you the one classic example I remember is that the Titanic one. Okay, so the the disaster of Titanic. I think there are the multiple things, but I mean, from the stock market at the perspective, there is an analogy. Because of the momentum, the overall, what I can say, that accident happened. I mean, they could able to identify, they put the brakes, but because it has a very, very high momentum, that is the speed into the weight. So because of the high weight, it has a very big momentum. I mean, very great, very high momentum, and because of that, it is not, it has not stopped even after applying the full brake and even reversing the engine, etc. So similarly, in the stock market, RSI is again the called as a momentum signal. Okay, and whenever we are applying this momentum signal in a, I can say, in a future option, which we will learn at level 3. Then we learn the, much more stronger application of this one. The complete, I can say, the options trading generally happen based on the sum of the concept which is developed on top of this RSI concept. Okay, so for now, just understand that, okay, it depicts the momentum of that particular stock, and again, it is here a single line, an uptick. I mean, uptick after a down. So uptick after a downfall is a potential buy signal, and downtick after a, up move, it is a potential sell signal. Right. So basically, when we are, we will be analyzing the chart. We will be first looking at a after support and resistance. The next two things we are looking at the MACD and the oscillators. Okay. Detailed one we will discuss in the implementation session. As of now, just understand these concepts. Okay. Yeah. And I mean, as part of the kind of a chapter four or the topic four within the level one, divergence is again the another uh, very very important and a strong topic, and it has the very very simple two meanings. Okay. So these two indicators to RSI and stochastic. Okay. So what happens when it is called as a divergence or a bullish divergence? Basically, there are two kind of divergence. One is the bullish and the bearish. Okay. And what it represents is whenever there is a downtrending market, and downtrending market means the stock prices are making lower low uh, and lower high. And in such a situation, after a certain period of time, that definitely there will be a some reversal, because any typically any stock which is falling, it will not fall forever. It may be a correction till certain price point or till certain period. After that, it is going to go up. Typically for the blue chip company, I'm excluding the examples like a S Bank. S Bank is exceptional case because there are many other factors which is impacting S Bank and maybe a few more. But any blue chip companies like TCS, Infosys, Wipro, Tata Motors, Reliance, or any any company that you name it. Okay. Um, I mean, which are known. I mean, the FMCG company like a Britannia, or Nestle, P&G. Okay, so after whenever there is a correction in the market, that means that there is a downfall is happening. After a certain correction, it is again going to go up. And the divergence, via the divergence, we should be able to largely identify when is the reversal is possible. I mean, there are some price point that we have. Sorry, the chart pattern we have seen like a double bottom or inverted head and shoulder. This is the another uh, kind of concept which gives the better conviction on top of those chart patterns or the candlestick patterns. So in the bullish divergence, the price is making a lower low. That means the current price is the lower than the previous price point. However, the corresponding RSI value or the stochastic value is not supporting that fall. So if you look at here, this price point is lower than the previous price. Okay, but the RSI is kind of a flat, or even this is slightly up. So that means the strength of the falling market is not that. The strength is getting weak, and it is basically indicating that, okay, from once we observe such a phenomena, that price is making a lower low, but oscillators are making I can say higher low. That means both are, one is say the price is going down, but the corresponding oscillators are going up. So that means they are not in sync. And in this situation, there are a potential chances of a reversal signal. Okay. So if these divergence, we could basically the bullish divergence when we observe on top of the other concept like a chart pattern and the or a candlestick pattern, it gives the much stronger conviction. So either we can um, take a fresh entry into that stock, or maybe if we are already into the short selling, we can plan to exit at that level. So this is the bullish example. Sorry, bullish divergence. Another example was the bearish divergence, which is the exactly opposite. So bullish divergence means how to remember. I mean, there is nothing. I mean, not it is not really needed to remember, but only we need to remember is that if the price is falling, and if the current price is lower than the previous low, in the similar way, the RSI and stochastic, maybe it is the current low is the higher than the previous low. It is the opposite. Okay. So that is the bullish divergence. Bullish, why it is called bullish divergence? Once we see such a divergence, After this, that means the market is going to be a bullish market. That is why it is named as a bullish divergence. After divergence, it is going to become a bullish. Similarly, bearish divergence means whenever we see such such divergence, it is market is potentially going to go bearish. Bearish means some correction mode. So if you look at okay, so somewhere uh, maybe I can say January 22, 2022, the Infosys has made the all-time high. Okay, and this the all-time high was definitely the higher than the previous high. At the same time, if you look at the RSI and the stochastic value, so RSI is making a lower high. Okay, so these are not the price up move is not in, or sorry, the RSI move is not in sync with the price up move. So RSI is getting weaker. That is the reason RSI is coming down, and even the price is making up. So that is may if whenever we see such phenomena happening in the stock market, get ready for the if you are already into the stock, already purchased that stock, you can maybe think of exiting your position or selling your stocks. Okay, because why we are purchasing any stock, that whenever the market is going up, we should able to get some profit, and we can only get profit whenever we can make a end exit, and exit should be with some profit. And how to make an exit? So these are the one example via which we can decide that if divergence is happening, that means mostly price is not going to go up further. And this example, we are seeing the divergence in the weekly time frame. So weekly, any divergence in the weekly time frame, that means it's a very, very strong, conviction that, okay, there's a 90 or 95% chance that, okay, price is going to fall after we see this kind of divergence in a higher time frame, especially if a daily, weekly means that as bigger is the time frame, your conviction of the correctness or the what is happening, uh it will be it is stronger basically. And once, if in this example we have, if we can see, since then the market is falling. I think the Infosys has fell till up to 1200. So from nearly 1950 to 1200. Okay, so it's a big correction Infosys is having. Okay, so these are the basically three concepts as part of the fourth chapter. Is there any question that then we should able to discuss it?
No, nothing specific.